Money. Money.
It is that time again. It's coming up soon. Tax time. We are hitting the beginning of April, so you're going to be getting ready for this. And some common mistakes that can be made doing your taxes that I wanted to share with you today. Unsigned returns. It's the easiest part about doing your taxes, but some people forget to do it. So make sure you don't leave that out. When you file online, you won't be able to submit the return without your typed signature. 2 signatures if you're filing jointly. But when filing on your own, this is often overlooked. An unsigned tax return is like an unsigned check. It's not valid with the IRS states. So wrong Social Security number is another one. While you should have your own Social Security number memorized by now, taxpayers often enter in the wrong numbers for their children and other family members. So if you're unsure of the number, get Social Security cards out and copy it from that. Otherwise, you risk getting your return kicked back to you by the IRS. Wrong name, apparently. Many taxpayers can't spell their names correctly. The IRS states putting the wrong name on a tax return is one of the most common tax errors. This mistake also comes up a lot after a person has changed their name, after getting married or for some other reason, and the name they write down on the return doesn't match the name on the IRS system. Wrong filing status. You should be pretty certain about whether you're married or single, but what often confuses people is whether to choose head of the household or single as their filing status, according to the IRS. Primarily, this is happening with divorced parents and minor children. Either confusion as who the legal entity to claim the kids sets in, or one of the parents is illegally attempting to claim the children and the filing status that accompanies them. So tax filing programs like TurboTax or H&R Block will help you figure out the right status to choose. But if you're filing on your own and unsure which status is correct for your situation, you can go to the IRS website to use as an online tool. Mistakes claiming credits or deductions. It's common for taxpayers to mistake a claim deductions or credits that they don't qualify for, to miss out on some of the same tax brackets when they do qualify. The credits that are most common abused or neglected: the Earned Income Tax Credit, the Child and Dependent Care Credit, and the Standard Deduction. Now, with ever-increasing complexity of the tax code, it's no wonder they continue to see errors on the credit or deductions. So if you're filing solo, make sure that you read the instruction carefully to ensure that you qualify for a given credit. Otherwise, tax software should help you determine which credits you can and can't claim. Now, wrong bank account numbers. When requesting a refund via direct deposit, you must enter the bank account number on the tax return. But even if one number is off, the IRS won't be able to transfer your refund into your account and will send you back the return back to fix those mistakes. So obviously we don't want that. You want to get your money back if you've got any coming to you. Now, math errors is another one. The IRS states that people who file with a pen and paper are 20 times more likely to make mistakes than those that file who do e-file. While tax software will crunch the numbers on the tax return for you, filing on your own will require some additional add and subtraction. So make sure that you double check the figures by submitting your return. If you file by paper, it could take a while for the IRS to process the return and identify the mistakes before sending it back to you. So if you're filing electronically, however you return will be rejected immediately if there are any incorrect math, and you will need to resubmit that. Now, last is I just want to remind you about mortgage insurance. The mortgage insurance write-off, PMI or MI, is now a write-off again. So thanks to the Tax Relief in the Health Care Act of 2006 and the Mortgage Forgiveness Debt Relief Act of 2007, mortgage insurance premiums were tax deductible and treated the same as mortgage interest. We lost that benefit, but on December 18th of 2015, the president signed legislation that renews the tax deduction of mortgage insurance premiums for qualified buyers through 2016. The deduction is effective for purchases or refinances loan close after December 31st, 2014. Mortgage insurance premiums paid to occurred after December 31st, 2014 and through December 31st, 2016 may qualify for tax deductible for homeowners' federal tax returns. Now, this would apply to your monthly mortgage insurance as as well as your buyout. If you've heard me talk about mortgage insurance before, as my profession is a mortgage consultant, I'm really favorable over the buyout mortgage insurance, or what's called the single premium. So you're paying a one-time fee upfront to buy the mortgage insurance out upfront, so you're not paying that monthly mortgage insurance. So you may forget that you actually have mortgage insurance. You've paid for it. So your mortgage is still insured in case you default. The bank's going to get their money back, or a percentage of it. But it is still mortgage insurance. So you get to write that off. So make sure that you don't forget about that. So there's my money chat for today. And coming up next on the Money Hour, does your self-talk matter? Yes, it does. How changing your thoughts will change your life. Deborah Trapin, owner of D11 Consulting, speaker, coach, author, and dynamic woman that I am proud to call my friend, right here on 1150 AM at KKNW after this short break.